Welcome to the insurance series. I'm William Freitas from Confio Insurance, and today we've got Mathew Korff from Vector Insurance. Matt, welcome to the show.
Thanks very much, Will. Thanks for having us.
Today, we're going to dive into a little bit about your background, how you got into insurance, which is always an interesting story, naturally. But you're a bit of a topic expert when it comes to management liability, directors and officers insurance. So we're going to dive into those elements. But let's start with, what had you be where you are today? How did you get into insurance?
Probably similar to most people who sort of fall into insurance is I didn't really know a lot about it. I had a bit of an interesting background that I didn't come from a professional office-based job in the past. I was actually in the police for 5 years out of school. I went to uni for a year, and then I wanted to do something that I always wanted to do, was be a copper, and that's something that I wanted to do since I was about 12 years old. And I did that. I went into the police, and during that 5 years that I was in there, I sort of got the travel bug. And during that time, I went to London a couple of times, and I just realised I want to travel, and I couldn't see myself after about 4 and a bit years staying in the police and seeing that as my career. I never had an office job, so to speak. So when I came back, I wasn't really sure. I didn't have qualifications. I started uni but never actually finished it. And then I had a mate who was in insurance. He was in credit insurance, and he was a good mate of mine, and he did something similar to me. He said, well, the funny line that he said was, Korffy, if you've got half a brain and you can talk to people, you can be an insurance broker. So that was my introduction to insurance. I thought, well, I've got half a brain and I can talk to people. And I sort of really started at the bottom. I got a job as an assistant account executive at Marsh, which was a great way to start because it was starting at the bottom, learning the fundamentals and working my way up. So I did I was 10 years at Marsh, and I started as an assistant account exec, and then I moved to an account exec and then principal. And after about 9.5, 10 years, I wanted a bit of a break. I wanted to try something different. So I was actually asked to go over and be an underwriter at Zurich. So I'd never been an underwriter before. I worked as a broker for 10 years, always in financial lines. I've always specialised in that financial lines area, which is predominantly directors and officers insurance, professional indemnity. It sort of expanded out a little bit more around information technology type policies and cyber and those types of public liability policies. But I've always mainly specialised in that area. So when I went to Zurich, I went in as a senior underwriter at Zurich, and that's where we met, Will, back in the day. And always working in those larger programs, like we had some quite large directors and officers programs like construction PI and large multinational policies that I did. And then did that for 3 years. And after that, I sort of went on a little bit, and I had another mate who was working in an underwriting agency, and he said, come over and work as back then it was a regional manager in underwriting. So I'd only been an underwriter. I hadn't managed anything, but I sort of wanted to evolve and I wanted to run a P&L and I wanted to manage staff until I realised how difficult it was running a P&L and managing staff. I did that. So I went over to a little underwriting, I thought it was a little underwriting agency, but it was quite a large business that continued to grow called Jewel Australia. And that's where I started as a regional manager for the New South Wales, Queensland sort of region. And then after about 3 or 4 years, and there's a bit of a pattern here, I sort of get a bit itchy feet. I think it's a little bit of ADD or undiagnosed ADD, is that I wanted a new challenge. And that new challenge was the claims manager. So I've gone from broking to underwriting and then went into claims. And I thought I would do claims for about 2 years. I ended up being there for 9 or 6 years doing claims, and then sort of think there was a bit of a mess in the claims area at that time. We sort of fixed that up, and then I was asked to do the same in New Zealand, and then went and ran New Zealand as well, and then same in Asia Pac. So I actually went up and did some time up in Singapore and did that. So the journey has been quite interesting in that it started from nothing, working your way up, but then covered, I guess, the 3 real great areas of insurance, which is the broking side, the underwriting side, and the claim side. So that's kind of where I got to up until about post-COVID. I wanted to get out of being a claims manager at that stage because it was it was quite intense. I was handling a lot of the claims, obviously, for dual, but also handling a lot of the accident health, corporate travel claims that came out of COVID, which was quite challenging. And I thought, I just want to go back to what I guess my fundamental is, what I really enjoyed, and that was financial lines broking. And that's where 4 and a bit years ago, I started at Insurance Advisor Net. So kind of been following you around, Will, a little bit.
And let's touch on that. Obviously, yeah, we had the luxury of crossing paths and working together at Zurich and working on some large directors and officers insurance. We can touch on that, but you've obviously had the luxury of being across all 3 areas: broking, underwriting, and claims. If you had to give us a 2-line synopsis as to what you enjoyed about each and what you didn't enjoy about each, what would you say? And even give us a favourite potentially.
Yeah, I think going from broking to underwriting, it's funny. When I went from Marsh to Zurich, they said, "Oh, you're going to the dark side." So as a broker, you were going to the dark side, becoming an insurer. But when I got to Zurich, they said, "Oh, you've come from the dark side." And there was always this, you're a broker, you're an underwriter. But to experience both has been fantastic. And what I realised was there is a bit of broking in everything, in every role that I've done. And that's why I think having the fundamentals of being a broker first really helped me being an underwriter, and it really helped me being in claims, because really broking is you're just a conduit between two. Yeah. So you are in between the client and in between the insurers as a broker. And that's what I really liked about broking. That was my favourite part, is I like being involved in the whole process, both the client, working with them and finding their solutions and getting their insurance programs and putting big D&O programs together, and being involved negotiating with the insurers to actually get that and put it together. So that's what I liked about the broking side. The underwriting side was more of, I thought it would be more analysis, but which it certainly is, because obviously you're in charge of capital and you have to make sure that you're underwriting the right risk, and you have that. But I didn't realise how relationship-based it was. And that's where I said, coming from broking to underwriting, it is a relationship business. Now, whether you're in underwriting, broking, claims, or you're a risk manager or a client, it's really working with people has always been the favourite part of it, and being in the middle of it. There's challenges in all those roles. Claims, I thought, was fantastic because you actually see what actually happens. As a broker and as an insurer, you're really putting these programs together for the end result, and the end result is a claim. It's hoping that never actually occurs. And when I got to be in a claims manager role at a large underwriting agency, you got to see the whole process of, you dealt with the brokers, you gave the capacity, or you gave the indemnity, there was a claim, and then you handled the claim. So that's what I liked about the claim side as well. I was in sort of a more senior role, so I was handling more of like an operational side of the claims as opposed to the day-to-day claims. But claims is pretty simple. It's either covered or it's not. If it's not covered, you've got to let the broker know quite quick because they're representing their client. If it is covered, you pay out the claim. If it's not covered, you let them know, and you let them know quickly. So there is a little bit more to it than that. There's some grey areas in between, but that's fundamentally what you're doing. And I think doing those previous roles has helped me in every single role that I've done. So doing broking helped me as an underwriter. Being an underwriter helped me as a claims person. And now going back to having my own business, it's so much easier to negotiate with insurers. You've got some knowledge of how the claims work. You know where things are paid. You know the appetite of different insurers. So that's probably a long way to say the goods and bads of each of those areas, but they've all been equally fun and equally challenged. What's my favourite? It's still broking. I think I'm a broker at heart, and I guess that's proven in that I've come back the full circle after about 15 years or 14 years doing claims and underwriting.
And I think what's important too is understanding what the underlying risk is. As you fundamentally already pointed that out, despite being, whether it's broking or claims, having an understanding of what the client does and how it is that particular insurance might be able to help, whether it's going to cover it or whether it's not going to cover it, is what is fundamental to the whole process. Let's go back to the Zurich days. You know, you and I did quite a lot of directors and officers liability insurance. And many people that hear that might initially think that it's just tailored to ASX listed entities. And don't get me wrong, I spent a lot of my time looking at ASX listed audited reports and, you know, reviewing those risks most certainly. But there is certainly a risk for directors insurance for SME businesses as well, which is then what we would classify as management liability insurance. And that's effectively what the insurers have packaged together to, I guess, cater for the SME market. So let's touch on, you know, what does directors and officers insurance cover? And what's the difference between management liability?
Yeah, I think what you mentioned there is depending on the company that you work at, some specialise in those areas more than others. So, for example, when we were at Zurich, we were working on larger directors and officers programs, and there were larger clients that happened to be ASX listed companies. But also too, we saw that the market has sort of merged a little bit to cater more to cover directors in an SME space, a smaller space, and that's where management liability came into it. I guess before I talk about the differences is every director or if you've got a company as a PTY limited company, you need some level of management liability or directors and officers liability cover, because effectively your personal assets or your exposures are at risk just in being a director. There are so many different legislative areas that a claim could come against you. And when that claim can come against you, they're noting you individually. They will say, William Freitas or Mathew Korff, as a director, you are liable for X, Y, and Z. And I can come to some claims examples in a moment, but every SME should be doing it. And as a broker, you understand that it is sometimes difficult to get that education of why you should be buying those types of policies. But I guess to answer your question, the fundamental difference between directors and officers liability and management liability cover is they're both covering directors. They're effectively covering the directors for the exposures that they have in managing a business. That's pretty much the easiest way to explain it. The difference between the two is that management liability covers a little bit more, whereas directors and officers liability standard policy will cover the individual director. It doesn't cover the company. For exposures that may come against them. And that's why management liability came in about 25, 30 years ago to cover both the individual directors and the company, or the PTY limited company. But then they started putting on extra coverages, like where they saw claims come from. So directors really, for the larger companies, it's misrepresentation type claims or non-disclosure type claims, or ASX listed, non-compliance with ASX listing rules. They're sort of mainly for the bigger companies. But for the management liability, the smaller SMEs, it's really for employment practices type claims, statutory liability claims, so breach of certain statutes, and crime type claims. But then they've sort of evolved and merged, and they put things in like tax liability covers and things. So the management liability is just so broad. It's a crazy amount of cover, and I've seen it through managing a claims team and going through a corrective action, you'd probably call it, at an insurance company, where management liability just became so big. It became so big in terms of the size of the companies that you're covering. So you could have a PTY limited company up to about 500 million. Now, that's not an SME. That's a big company, which really should be purchasing standalone directors and officers cover. But then you've got companies that have so many different exposures, and you don't know the way you underwrite it, especially if it's an online platform. You're covering management liability. You'd be covering a company that could have 15, 20 different companies underneath it. But it's very, very broad. And that's the kind of difference between management liability and directors and officers. Directors, not just ASX, but the larger companies, it's probably more applicable, and there's more sort of policies aimed at those directors. But for the SMEs, I would say up to, I think only $50 million is probably the cap, I would say, at management liability. But I wouldn't be sitting on a board, or I wouldn't be running a business without some level of management liability or directors to cover.
Yeah, and it's funny that you say this because depending on the insurer and depending on what country you're in, even the classification of what is a small business varies so substantially, right?
Yeah.
And so, there are insurers most certainly that will do management liability insurance up to 100 million. You said even in some instances 500 million. Why would you say businesses should be considering standalone directors insurance if they're above 100 million, for example?
Yeah, I think it comes down to what you mentioned then, is whether the insurer can actually provide it or not. Ideally, as a directors, and I guess I started off as underwriting directors and officers liability, and I always thought the reason that you're buying this is to protect your own assets, and you have a limit of liability under standalone directors and officers liability that covers you as an individual, as a director or whatever. And when you start getting bigger, those exposures are higher. So it's not exactly this simple, but big is bad in terms of you have a larger company above $100, $200 million, you're going to have a larger claim. You're going to have larger issues. But if you have that as a management liability, for example, you could have insure 1 year and might have $1 or $2 million limit under a management liability policy, and you could have a really nasty employment practices claim, or you could have a really nasty fraud, for example, or basically another insuring clause that wipes out what that directors and officers policy was always originally there to do, and that's to protect you as a director. So if you have a company where the claims are larger, you really sort of want to ring fence or keep those exposures as a director covered under a directors and officers, and it tends to be for those larger companies. That's why that's the difference between really the two. But it comes down to appetite. It comes down to whether the insurers can do it. It comes down to whether the client, they don't care about the other exposures and they're happy to share that limit. So, but I always think you've got to get back to basics. That D&O policy is there to cover you for the directors and officers in managing the business. So many things can go wrong. I would want my own limit.
And I think you explained it perfectly in the sense that management liability exists to cover small to medium businesses across various different coverages that still originate around covering the director.
Yep.
Whether it's an employment matter that the director will still be pulled into, whether it's a statutory liability claim that the director again will be pulled into, it's still there to cover the director. And I think from what I've seen in the past is, if they were to buy a separate policy for each of those sections of coverage, that would be quite cost prohibitive for a small to medium business. Hence why the management liability has really fit a really good niche, I would say, or served a good purpose for those businesses. But I agree. That initial question was really just to highlight limit, the recommended limit, or limit appropriateness for the client. Because, most certainly, as you said, if there's a $200 million business, the maximum management liability coverage you're going to get is probably 10 million, 20 million, maybe max.
Yeah. From one insurer.
And if you have one, maybe even two type EPL claims or commercial crime claims throughout the year, then you're really exposing your own personal assets. And so that's why it makes sense to have standalone policies for sure. Yeah.
And I think, some people want it and there's fors and against it, and you could do a whole podcast on the differences between the two. But under the management liability, you've got like entity cover, which is effectively, the directors and officers are covering the individual directors and senior management, whereas the management liability is covering the entity. So, for example, if you have a statutory liability type claim, and usually the stat liability are triggered through employment, workplace health and safety type matters, or environmental protection type. They're the type of claims that you hit. But if you have a claim, 80% of the time, or the claims that I've seen, is that they're going to name the entity and they're going to name the individuals as well. So if you have a management liability, you're getting those defence costs across the both, whereas under a directors and officers liability policy, you're only getting it for those individual directors. And the claims that I've seen is it's 80 to 90% of the times the entity is noted as well. But if they're scared about that exposure, they should buy, as you said, standalone stat liability, standalone crime to cover those types of exposures.
Let's go into that if we can too, around the entity coverage, particularly because you've had that claims experience. And we've seen some of our own experiences in the past. Where do you see at times where the entity is named and the personal director is named? How does that get proportioned? If you've got $1 million of coverage, you're an SME business, both the entity and one of the personal directors have been mentioned. Is it $500,000 each? How does that work?
It's messy and it's not simple. It's probably equivalent to the financial lines equivalent of business interruption type claims. They're quite difficult. But I think when I was, as a claims person, I guess the main thing you want to make sure is, and there's the provisions within the wording like allocation of defence costs and how you actually allocate between the directors and the entities and things like that. So there are provisions within the wording, but in reality, you've got to take a common sense approach, is that entities have bought this for protection and you want to ensure that you cover the directors first. And that's where you sort of get into different discussions of, how much of a limit should you buy? Because a lot of the times the limit is not only the indemnity to cover the individual for what they've done wrong or what they haven't done wrong, but it's the defence costs that you actually spend. So for certain types of claims, you can almost spend half of the limit just on defence costs. Yeah. So if you have a statutory liability claim, for example, someone's been injured and it doesn't matter what you do. You can put all the procedures in place or whatever. If a person gets hurt on the work site, the director is going to be named. Like work cover will be in there before sometimes the ambulance leaves. They will come in and the defence costs from day one are well beyond any excess deductible, sometimes premium of what you pay. So it's really, really important to make sure that you have appropriate limits for those types of covers. And that's where it really sort of blurs the line between appropriateness of limits as well. When you say for a big company, is $10 million enough?
And I think it's super important to note that management liability as directors and officers insurance covers both defence costs and a resultant compensation.
Exactly.
I think a lot of businesses out there misunderstand what it actually covers. Yeah. They might think it's just the compensation or just the penalty of some sort once they go through that battle. But no, it actually covers defence costs as well. And that is, in our experience, as you've rightfully mentioned, sometimes can be 75% of the claim.
Absolutely. And sometimes it's as a result of allegations where the directors or the entity hasn't actually done anything wrong, but they do have the right to be defended. And that's where, you try to let your clients know of the exposures that really you're buying this for defence costs. Because the moment that this happens or a lawyer has been appointed, that limit is almost gone, because in the end, and I've had some examples of larger statutory liability type claims. I know it's not management liability specific, but it's under that area. If you have an injury or a death on site, which is worse, that statutory liability limit can be almost gone. And from a reserving side, without giving too much of previous away, we know that hundreds of thousands of dollars are gone straight away, because there's going to be a coronial inquest, there's going to be police investigations, there's going to be legal, there's going to be family matters, there's going to be so many costs and legal costs as part of that before there's any fine or penalty, which is in stat liability, for example, is the indemnity. So 75% easy. We've seen the ratio of 110, 120%, where you're spending more on defence costs than you are actually out on the indemnity limit.
Yeah, that was really just an arbitrary number, but it can be largely defence costs.
Yeah.
And we're in a privileged position, right? Like, we see these claim situations occur, we see these risks occur all the time. And that's why clients work with us naturally. But when it comes to the conversation around adequacy of limit, like how much limit should I buy? How much insurance should I buy for this particular risk? And so we always talk to clients about various different things, like composition of board, how many board members do you have? What's the split between non-executive and executive? Turnover? What are some other things that you would suggest?
It's funny, as a broker, you'd get that question every week, but my response is, as a bit of tongue-in-cheek, is how long's a piece of string? Like, what limit should I buy? But and certain policies have, different philosophies of where you should buy. With cyber, for example, I would say it doesn't really matter what limit you buy, just buy something. Like buy some level of protection because you're going to be paying those costs from the moment that you have a cyber claim. Whereas directors and officers liability or professional indemnity type policies it is turnover, it's the assets, it's sometimes the type of contracts that they're getting into. The experience of the board, have they had claims against them in a previous experience? Industry, we've seen that under management liability, for example, certain industries are more highly exposed to claims, and they might be the transport industry or manufacturing or retail or construction. Those industries, if you take those areas out, and that's why it's a bit of a catch-22 is that you want to sell that type of insurance to those industries, but a lot of the insurers pull back on those industries because they know there's a lot of claims in there. Yeah. So it's a matter of, look, can you get cover? And if you do, what's the maximum you could be exposed to? And giving things like benchmarking against similar clients, that's what I do. I benchmark against similar clients. But also looking at, some of your experience of where you see those claims coming from, but also talking to your client and just saying, look, if you do get a claim or something goes horribly wrong, what are you exposed to? And they'll put up a potential amount. Now, sometimes that's more than the assets of the company. Yeah. But also sometimes when it comes to limits, to talk about how much limit you should get. Some clients are they're more risk, they're concerned about their risk, but they go, I want, a $20 million management liability limit, but the assets of the company are only $2 million. And you go, well, insurers aren't going to do that because the insurance policy becomes the biggest asset of your company. Effectively, that's an asset that becomes something in the future. So there's a lot of different areas, but I think debt benchmarking, experience, claims, they're all the type of things that I sort of help and guide them towards appropriate limits.
I think that's a key challenge in our industry, to be honest. I think I can appreciate where there's a $2 million business and a $20 million policy seems like it's the greatest asset. Yep. But as we've kind of already highlighted, depending on the number of employees, the industry that they're in, the experience of the board, the way that's, what the composition of the board, what their claims history might be, $2 million might not be enough, really. And so when you've got insurers who aren't providing that coverage, that's a real challenge. I think there's always alternative ways to do it. It might not be with the one insurer, if that makes sense. But that's where obviously working with a broker makes complete sense. Talk to us about type of claims, right? We've spoken about director type claims, but there's a variety of different claims from various different sources, right? Yep. Where would, I guess, clients expect to have claims come from that would be covered by a management liability policy?
Under management liability, so I can talk about different policies, but in management liability, we talk about covering directors, and I think as a personal exposure, you would buy the management liability to cover yourself. But the most triggered clause under a management liability is employment practices. So if you have 100 claims under a management liability policy, on average, and this is just only from my experience, but I know it's similar for other insurance companies, 50% of those claims are going to come from employment practices type matters. They're very much a frequency type policy. It's not a severity, as in they happen a lot, but they're not big. So I've seen data on employment practices type matters, and if you have an employee, you have an employment exposure, and they could be for wrongful termination or sexual discrimination or disability or so many different areas where an employee can bring an action against directors, and that's why it's triggered so often. It happens so much in terms of frequency. It's the most, but they're not huge. They might be, but the average EPL claim that I've seen is about $20,000. It's not huge, but that is huge for companies that a micro SME that should be buying these things. $20,000 could be, devastating to them across, how much they're making a year. But also too, there's other things outside of financials. There's reputational risk and emotional, and there's so many things that come about it. But the type of claims, the employment practices claims under management liability, they're the standard. It happens a lot, and 1 in 2 of actual claims are in that employment practices. So when I look to actually advise clients of why you should buy it for your self-protection, but buy it because if you have employees, and you know what it's like, you've got a very good team, Will, but things can go wrong. And we've seen it with other clients and, clients that we've had. Things do go wrong. And the bigger ones that you have, the construction, the industry, whatever, if you've got hundreds and hundreds of employees, retail, there's a good chance that you're going to have an employment practices claim.
And we always, to add to that, we always mention to our clients how that third-party liability component is the part that's hard to manage.
Yeah.
Many people would think, okay, what's an EPL claim? An employment practices claim is me firing somebody and then bringing an action against us. But it's not always about that, right? Harassment can be in all forms. It can be third-party harassment as well, whether it's one of your staff members harassing a client or harassing an external third party, which then the company becomes liable for, right?
Yep.
And so they're things that'd be quite hard to manage. And as a director, when you're liable for your employees, particularly the bigger the team gets, it's hard to manage.
It's very hard to manage, and the Australian regulatory environment makes it very easy to bring a claim. You can go to Fair Work, and it doesn't, there's certain criteria around it. But if you're an employee and you're aggrieved for whatever reason, it's very easy to go to Fair Work and get a claim. So, and on the flip side, you can have all the procedures in place. You can do everything right as per the requirements of a director. But if you fire someone, for example, and don't follow the procedure, even though you have the procedure, they're going to come after you.
Yeah.
So it's going to be seen, or you're going to be exposed as a director, even if you've got all the right procedures in place. If you just vary from those policies, it's going to come against you.
It's funny, we have a client who had a claims example. Obviously, won't mention client names, but I'll use the example. They were looking to hire a new role, a new staff member. They found who they thought would be a great candidate. They put the role out subject to reviewing references and criminal histories and the like. After offering the role, subject to those checks and balances, found that this person had a history that was of concern, grave concern to the business, particularly the way the business was made up of. They obviously rescinded that offer. That individual then went to the Human Rights Commission and brought a claim against the business.
Yep.
And the next question is, well, what is the loss? What am I concerned about? And it's the defense costs. It's representing the business up against the Human Rights Commission. Depending on how far that individual decides to take it, it can be quite a costly exercise.
Absolutely. And in terms of insurance, a lot of these are uninsured exposures because the directors haven't bought this type of policy. But when I mentioned the $15,000 to $20,000 average claim, I can tell you half of that is defense costs. So on all those claims that you have, half is you need someone there to hold your hand and work your way through it. And you do have to, it's good when you buy the insurance policy, you're getting the lawyers behind it and your defense costs behind it. But you may only pay out 10 grand for that wrongdoing, but you have to pay 10 grand to get to that point. So that's where your split of costs is coming. So it's something that as a broker, you think it's a no-brainer. I've seen it in claims, but I guess the challenge is trying to get people to understand it. And that's why I think over the years, we've started to see an increase in webinars and, in these types of things, podcasts. Just education is just so important because people don't know what they don't know. And when they haven't seen it, and insurance is always the last thing that they think of. They go, they've got so many things. They're trying to run the business. They're dealing with bankers and staff and everything. Insurance is the last thing. But when something goes wrong, it's the first thing they run to and go, where is it? Where's the cover? What have we got? Because it's very expensive. Like when it goes wrong, it can be very expensive to any SME.
And I'll add to that too, types of claims you can see from a management liability perspective or against directors are regulatory type claims or shareholder claims. And so we often see clients come to us who are either raising capital or thinking about raising capital and or have multiple shareholders in their boards. And this is a key issue, right? No one reads the 60-page PDS document outside of us. And particularly around management risk, what we see a lot of people forget about is the major shareholders exclusion.
Yep.
And when they're working with shareholders who have a large, share of the pie, if I might say, and they may not have board representation. And then when they bring a claim against the board for misconduct or whatever it might be, or allegations of such,
Yep.
that's not covered because the policy excludes that. And so I think that's super important to keep in mind.
Well, I think the majority of, you see a lot of the claims, because as a claims person in the past, when you receive a claim, the first thing you look at, yes, you're there to pay claims, but also too, you're representing your company as well. And if it's not covered, it's not covered. So the first thing they're going to look at is the exclusions. So is it a major shareholder exclusion, or is it an insolvency exclusion? That's a little bit of a different thing. But, is there an exclusion there that's going to deny that cover quite quickly? And that's really important, because a lot of these things are embedded, as you say, they're embedded within these 60, 20, pages or whatever. And as a broker, you're exposed, because if you have a claim, they'll go, well, why didn't you tell me about that? And you have to, obviously explain it. But I think one of the challenges is that you have to let clients know that you can sue each other. You can sue each other as a major shareholder, whatever, but don't expect to cover under the policy. And that sort of changes some behaviour and makes decisions. They're going, well, this director did this and this director, and it's like, yes, but as a result of this exclusion, it's not covered. And then it's like, that's when you start to get sort of issues. But it's always disappointing when you hear the insurance industry getting a bit of a rap for not covering things, but they don't really see how much you do cover and how broad some of these policies are. Like, outside management liability, it is so broad. There are so many areas that you can cover under one particular policy.
And I think it comes down to intention at the end of the day. What is the insurer not trying to cover versus what they are trying to cover?
Yep.
And in that particular instance, they don't want to provide coverage for you suing each other. That becomes a financial guarantee effectively. Yep. So if you've got board representation, you should really be sticking up your hand and saying, I don't agree with that particular decision, or I'm resigning, whatever it might be, so that you don't find yourself in that position. That's what the insurer is trying to do. So I think intention is a huge part to educate clients. And I think that is 100% the reason why clients need to work with advisors or brokers who understand management liability. Because it's so easy to buy a policy off the shelf, but not understanding these inbuilt exclusions is what causes huge issues. You mentioned insolvency.
Yeah.
We see it all the time. Insolvency exclusions can be removed from policies if you just provide your broker with your financial statements.
That's all. That's all it is. And as long as the financials look good, as in the financials are, and this is mainly for a directors and officers underwriting perspective, is that the financials is effectively a snapshot of how the directors are doing. Believe it or not, it's if the financials look good, you can pretty much assume that the company's doing okay, outside of anything fraudulent or whatever. But if you look at those financials and go, look, it's a profitable company, it's got a good cash position, there's clients coming in and, a whole bunch of other underwriting things, you can say, you don't need an insolvency exclusion on that policy, you can remove it. But the majority of management liability policies have that inbuilt into their wordings. So when you talk about intent of management liability policies, you can say, look, the intent is to cover all these things. But really, we as brokers should be saying, hey, the intent is not to cover this, this, and this. And shareholder exclusions or consensual claims exclusions and insolvency exclusions, they're something that really should be pointed out. And that's where clients should be using an advisor who not only understands those exposures, but it's probably a bit more of a specialty in that area. I think that's one thing I've never tried to be, is all things to all people, is that as in my business, I only focus on financial lines because I understand that, and I've done it for so long and I've seen different areas. And this is not a go at any other broker, is that I don't pretend to know business interruption type claims outside of cyber and things like that, but I don't understand large property programs because I don't do that, or large liability programs because I don't do that. Whereas we need to get the brokers to understand that management liability and directors is very specialised as well, and there's a lot of nuances within wordings that even we learn and go, oh, I wasn't really sure about that. They just have to understand that it is a specialty product.
And I will add to that too, what I find is a real issue, and this is where the industry gets a little bit of a bad rap, as well. But I guess it's just not understanding what the industry is looking to do.
Yeah.
Many clients or individuals who aren't necessarily specialists in this space will read the front page and go, oh, there's an insolvency exclusion. I've heard this plenty of times. We're not all that concerned about going insolvent.
Yep.
We've got a strong balance sheet. The insolvency exclusion's fine. Although the insolvency exclusion says any alleged or actual insolvency exclusion. So if someone brings a claim against that business that is alleging that it's insolvent,
yep,
not covered. No defense costs covered at all.
And it's very quick for a company to turn. And I've seen that with different clients, and my wife's got an accounting business as well. You've seen sort of different clients that it is solvent, but it could be on the edge. And if it is on the edge and there's allegations against it and you've got that insolvency exclusion, that's going to knock out that cover. But I think the important thing is what you raised before, Will, is you can get that insolvency exclusion removed. Just show us your financials. We'll have a look at it. If they look okay, they'll do it. I'm doing that with a client for a 30 June one right now. So it's
just about working with a partner who's going to hold your hand through that long-term process, because it is a 12-month renewal, right?
Yeah.
So if something does change at the 6-month or 9-month mark, you aren't really changing your terms with the insurer halfway through. So it's really quite important to have that foresight and being clear on how do we set this up in the right manner that's going to look after this business long-term. I completely agree.
Yeah, they're not sort of like working policies, as in, it's not like a motor fleet where you're adding a motor policy or you're changing deductibles or whatever. It's really important, as you say, we all speak to our clients throughout the year, but it's really important for the client to say, if there is a change, let us know at the minimum before the renewal is done, because they are annually. They are new contracts each year. And if something's missed or something gets left out, you could potentially lose the cover there.
Talk to me from a risk management standpoint. One of the questions we get all the time from our clients, and we really enjoy talking them through this, is how do I reduce my premium? How do I reduce my risk so that I can be effectively reduce my overall expenditure? What does that look like?
Don't have claims. There are ways to reduce your premium, and the problem is if you're a client with an online policy, you're not going to get that level of service that an advisor will do. This is our job to say there are ways to actually do that. And from an underwriting perspective, there's not a whole bunch of different things that move the dial in terms of underwriting and how you get to the premium. So for example, if you're looking at management liability, it's revenue, employees, industry, have you had claims? Now there's sort of areas within there that can change things, like have you got risk management procedures and things like that. But I think the thing that really changes the dial, depending on the size of the business, and what I've seen is if you're comfortable with your internal risk management procedures, and nobody ever thinks they're going to have a claim, but if they don't think they're going to have a claim and they're happy and you can see procedures for certain areas, increase your deductible, take on a bigger risk, put some more skin in the game, and you can say that to your broker, who can go to the insurer and say, hey, this is 20K deductible. My client, if in the unfortunate circumstance that there is a claim, can take on a 50K deductible. That's where you're going to reduce your your premium. Or if you're happy with an insolvency exclusion, you don't think it's ever going to, because insurers will most likely add an additional premium to take the insolvency exclusion off. Just ask them if they're happy to keep it on, can you give us a reduced exclusion, or a reduced premium? So there are different areas that you can actually, coverage and deductibles is the way that I've seen some premiums come down, but also too, it goes on the industry as well. Like, we're looking at premium reductions just because we know that this market is more competitive.
I completely agree. And I think, like you said, if you're going and purchasing a policy online, you're not going to have any flexibility whatsoever.
No.
And I think even when you increase your excess, there might be the smallest amount of reduction. But I think the biggest area is when you're dealing with an advisor like us or a broker, it's about being very clear on what your risk management looks like. Selling that to the insurer is what makes a huge difference.
Yep.
Then on top of that is the excess, for sure. But giving them some comfort around, do I have my HR policies in place?
Yep.
What's my safety workplace health and safety procedures look like? Am I managing my risk adequately?
Yep.
And then consider excess. Because I will say on the excess front, I always enjoy those conversations because sometimes some clients are like, oh, we'll never have a claim. We'll take on a $20,000 excess. And it's like, well, just remember it's an each and every excess.
Yeah.
You know? So if they have 2 or 3 of those, that's $60,000 a year. So
and I think it depends on the size as well, what you said. Well, like what I found is like, and this is for larger clients, and you can't do this for every client, is put the client in front of the underwriter. If you put that client in front of that underwriter and that underwriter feels comfortable and they've eyeballed them, it's amazing the results that you get as a broker by just putting them in front of them. I can tell you as an underwriter, I love talking to clients because you actually get to see the risk. And you, as the underwriter, he's got to tick all his boxes, but you can say, I met this risk manager for this ASX listed company or this general counsel. I'm comfortable with their procedures, what they're doing, and I know they know what they're talking about. As a result, I can therefore justify a premium decrease. I just saw it in a big renewal I did. If I didn't put that general counsel in front of that underwriter, I don't think I would have got as good a result. Still would have got a result, but not as good because they start to build a relationship with their insurer.
Yeah, we've had plenty of great examples exactly like that, you know, particularly when it comes to renewal, getting clear on what their strategy is coming forward, showing the underwriter or the insurer how it is that we're reducing risk and improving that risk. That really facilitates the insurer going back to their internal procedures and going, this is how I'm reducing my overall risk on this particular client. This is why we should charge a better rate. And I also am one to believe that it's much harder for an underwriter to say no in person.
It is. But you've got to have a story. Like you've got to have, as a broker, if you go to the insurer and say, I want a 5% reduction, as an underwriter, I would have said, why? Why should I?
Absolutely.
And you go, well, if you come with a story and say, they've had no claims, you've been on them for a number of years, they're happy to take a higher excess, whatever, you'll get a better result. But you don't get that online. You only get that with an advisor.
Matt, I think we could talk for days on this stuff. Like naturally, you and I are very passionate about it. For everyone listening, this might be the first time that they're hearing about management liability or directors and officers insurance. To really sum it up, it is a very similar coverage. The intention is to cover directors in their capacity as such of directors. And so management liability is a product that was created for SME business to facilitate the sub $100 million of turnover, potentially, sometimes even less, depending on which insurer you're talking to. But really is packaging different risks like employment practices liability, commercial crime, statutory liability, and more importantly, the coverage for the company. Matt, it's been a great conversation. Thank you for coming on the show.
No props. Thanks for having me.
No doubt people will find an incredible amount of value in this conversation. So thank you.
Thanks very much, Will.